Welcome back, traders. Rober is here. Today, I have an energy-saving entry point for you. Today's technique, apart from using SMC or smart money concept, we also use the appropriate time to enter the trade. Let's meet with this technique. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. First of all, a brief overview of the time period in trading. The graph you see now, it controls the time for 1 day. The best time to use is 5 minutes, 10 minutes, and 15 minutes. Don't forget, we have to adjust the time zone to UTC-4 or the time of New York. After adjusting, the time will be like this. The first period from 8 p.m. to 2 a.m. in the US is when the Asian market opens. The next period is London, which is the European market in the late to early morning of the US. And the last period is when the US market opens from 9:3 a.m. to 4 p.m. This area, if you look closely, you will find that the zones are intertwined. It was the last period before the London market closed and the first period when the US market opened. During this period, there will be a lot of tension because investors from 2 markets around the world are entering the trade. We call this zone the silver bullet zone, and we will use the silver bullet zone as the entry point for the trend today. Next, if you look closely, the price behavior in each period will not be the same. By each day, the price moves 1 round. We'll use the principle of power of 3 or AMD. The shape will be like this graph. In the first period, the price is bouncing in a narrow curve. During this period, it is set to be A, accumulation, or during the time of storage. Next will be the M, manipulation. The big line that controls the market will make a price shift. Let the price hit the stop loss. After that, it will go back up. When it goes back up, the big line that has been stored all the time will take the item and release it at a high price. During this time, it will be D or distribution. And when the AMD round is over, the price will have a chance to go back to the first phase. That is A again. If we use AMD to try to enter the pair with various markets, we will find it like this. During the Asian market, most markets will be quiet. The price is sideways. The price is in the narrow corner. In this area, it will compete with accumulation or A itself. When it comes to London, the price will break out a lot. And most importantly, there will be a stop hunt. When it happens, there will be a structure shift. The price goes back another way. Therefore, in this area, of course, it is manipulation. And finally, during New York, the price will rise. After that, it'll be quiet in the next period. This area is the distribution of large amounts of goods to be released at an expensive price. For this period, we will focus on 2 points. The first period is the structure shift when the London market will close. And another period is when the price rises in the morning of the New York market. Let's take a look at the example. This example, I marked the zone with all 3 zones. The first zone on the left-hand side is the Asian zone. The price is in the narrow corner. It's a collection. The next zone is the London zone. In this zone, the price will be very high. This area is a manipulation. And the last period is New York. The price goes up and becomes a distribution. And the area where the price starts to go up will be the end of London or the beginning of New York. Another example, there are 3 zones as before, Asia, London, and New York. During the Asia period, the price is the same as before. The price is in the narrow corner. When it comes to London, the price is manipulated. Finally, the price comes to New York, which is a release. And as before, the end of London or the beginning of New York, the price will go back. The third example, there are still 3 zones as before, but the price moves back. In the first period, the price was in the narrow corner. When compared to other periods, it's a storage. When it comes to the second period, London, the price will be turned to one side. In this place, it turns up to the top, right? After that, when it comes to the New York market, when the price of London is about to close, the price will drop. Therefore, in this area, the price will fall back. After the release, the price plummeted dramatically. These 3 examples allow us to create an example. This example, I would like to name it New York Reversal. The idea is simple. The price will return during the New York market. The main reason that is hidden is that the big line has been released, and we will help this opportunity to enter the trade. According to the big picture, there are 2 types of trading, be conservative and be aggressive. Conservative, we will focus on safety. The profit may not be much, but we are sure. As for aggressive, we will measure the fortune. Focus on profit a lot. If you measure the fortune and get good results, the price has a lot of opportunities to get RR. And all the examples in this clip will be used in the 5-minute time frame. Let's take a look at the first setup. Conservative left hand is the London period. Right hand is the New York period. The area where they are intertwined is the silver bullet zone. The shape is as follows. The price was chosen from London. When the price goes down to 1 point, this point is the silver bullet zone. The price will go back down from the bottom to the top. Therefore, in this area, we can observe a return by market structure shift. When it occurs, it will create a zone, which is the order block and the fair value gap. The price rises and goes back up. When it moves back, it has a chance to hit the DASO 1 zone. Sometimes it hits the FVG, sometimes it hits the order block. After hitting, we will buy. After buying, the price will continue to rise after it returns to the end. Once again, when it returns, it will be in the silver bullet zone or New York. Therefore, it is a New York reversal. Today, I have a conservative trading example to share with you. Let's start with the first example. The left hand is London, the right hand is New York. The area where they are intertwined is the silver bullet zone. We will look at the setup as in the example just now. The first step is to choose the price. In this example, the price is the market price. When the market structure shift occurs, we will look for the order block, which is at the bottom. At the same time, we can mark FVG at this area. Notice that when the market structure shift occurs, the price will not return to FVG. We can look at this setup and wait for the price to go back to FVG. If you look at it, it's only 2 steps. 10 minutes have passed. The price went back to FVG, we bought, and the price really went up. This kind of trade occurs in the New York period. It's called New York reversal. The second example, the shape of the graph is still the same. The price went down to the market first, making a lower high and a lower low all the way, until when it enters the silver bullet zone, that is, this zone. The price goes back to the market structure shift. When it happens, we look for the order block, which is at the bottom. In addition, there's still a fair value gap on the upper side as well. Therefore, the zone is complete. After that, wait for the structure as before. The price will rise and go up again before it goes up. The time it goes up is very beautiful. But in our FVG, we buy, the price will have a chance to go up for a long time. This shape is in line with New York reversal or our own price. The third example is still the same. It's a market down, back up. We mark the zone first, that this is the silver bullet zone. After that, we look at the price structure. The price is down with a slight trend. Make a lower high and then make a lower low. At one point, the price seems to go up. This point is the market structure shift. We can look at the order block, and on the top, there will be another fair value gap. The price will rise and it will move back to the Dyson Zone 1 zone. For this example, it hits the FVG again, hit many times, before it goes up. Therefore, if we buy, we can buy in this area. After buying, the price really goes up, like the structure that I drew for you at the beginning. The next example, the fourth example. Let's turn our heads. From the market up, back to the market down. The area where it overlaps is the silver bullet zone. The price has been higher high and higher low all the way. Therefore, we will look for a setup like this. The price has to go up before the market structure shift occurs in the trend. After that, we will get 2 zones. If you look at this example, the point where the market structure shift occurs will be a little before the silver bullet zone. After that, we mark the zone as before. The order block is on the top. There is a fair value gap. We got 2 zones. We wait for the price to come back to zone 1. For this example, the price broke the fair value gap to the order block. Finally, the price really went back during the New York reversal. The last example, the fifth example, is for conservative trading. The price is going up. We find the time to enter the trade when it returns. The point we are going to enter the trade will be in the silver bullet period as before. Let's look at the price structure. The price goes up to the point where there is a market structure shift. This point may be a drawback, that the real market structure shift should be in this area as well. The price went back from the latest high and became a downtrend. Therefore, in this area, we can mark the order block and mark the fair value gap as well. Finally, the price went back to both zones. But in zone 1, we don't lose money because most of our stop loss will be out of the order block. When it's done, we open the shot. The price has a chance to go back down. Finally, the price really goes back down. Go down for a long time. It's also a New York reversal. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.